No, you cannot. Well, you can keep that if tomorrow morning, before morning tea, see the very short man up the back there? That's him. He's very, you can miss him so easily. Imagine if he was playing rugby league this evening. Boom, you need a little bit more on your bottom. I think you have put some of these silver ingots into your bottom and you probably gave enough gravitas then. But Andrew, you are tomorrow?
Presenting at 10:30 for Investigator Resources, and whilst we're the only silver project here at the RAU in Gold Coast, we're also the only one giving away a silver bar, so you have to be here to win it.
Correct, and we're a bit brutal like that, so you have to be here to win it in the morning, just before morning tea. Do you all have the deal? But it's a secret, but you have to be in the room, okay? That's it. So if you don't want to tell anyone else out there, that's fine. We understand completely. But put your hands together for Andrew, because it's a very sizable prize, that's for sure. Actually, I think Strike Energy, and our last presenter tomorrow as well has got some really nice wine too. You need to be in the room for that one. Matthew Keane, where did you end up sitting, sir? Here he comes, front and centre. So we've got one session to go. We've got drinks at the end of it. Matthew Keane is the Managing Director of Great Southern Mining. He's got over 20 years experience in exploration, in mining, and also in financial markets, including 8 years as a resources analyst. He joined Great Southern back in 2022. He was wooed by the company's quality portfolio of gold and base metal exploration assets, which are located in Western Australia, and some of them might even be located over here. So the poor man had to come and live over here for a little while. And if you go and have a chat with him afterwards, he may be able to relate to you the story where he was almost barred from a mine site one day because he didn't know that there was a state of origin match on. So ask him about the little pickle he got himself into when you're going and asking him more about investment opportunities. But as far as an investment opportunity goes, Great Southern Mining. So if you're looking for a company that's got advanced exploration assets within 40 kilometres of existing and very hungry mills, and one that has a very big presence right here in your hometown in Queensland, then I invite you to stay. We'll close the back door and listen to Matt. Would you make him welcome, everyone?
Thanks very much, Chrissy. I feel like I'm on the back foot immediately. I haven't got a bar of gold. We're a gold and nickel explorer, but unfortunately I haven't got one of those to offer you. I'm also, looks like I'm on the back foot with the state of origin as well. Or I could gamble this off if you like. Okay, I'll jump into it, but go the Maroons anyway tonight. Okay, usual disclaimer, you can have a look at that on the website tonight if you like to have a last read before you doze off to sleep tonight. First of all, I just want to, this is our corporate oversnap. Every company has this. The key thing I want to point out with Great Southern Mining is the bottom part in the gold there. Our board and management are very much invested in our company ourselves. So 27% of outstanding shares are actually owned by board and management as we speak. Okay. I'll leave that there. You can also have a look at the presentation online if you want the further detail from that one there, but sort of into the main event. Look, we're a gold, nickel, copper explorer. We're primarily based in Western Australia and Queensland. We've got a pipeline of assets. Today, I'm only going to speak about 2 of those. They're the main focus at present. I could be here for 20 minutes. I'll talk about the whole lot. Look, we're exploring in advanced districts. We're purposely targeted in low-risk jurisdictions. So we're in what we believe are the 2 best states in Australia. That's obviously WA and Queensland. A key point, which Chris pointed out, all of our projects are within 40 kilometres of existing mills. And in a slide upcoming, I'll just highlight why I think that's very important. You know, we've got to differentiate myself when I'm up. Well, I've got to differentiate myself when I'm up here, but I think that's a key differentiator. We've got looking for the right commodity within range of existing infrastructure. We own all of our projects 100%, and we've got board who's got skin in the game. Okay, just on a bit of a theme, I'm not sure how many people are aware what's happening in the west, but in the northern goldfields where we're operating, so this is the Laverton, Leonora area, there's what I'd call a game of mines underway, a bit of a play on Game of Thrones there, but there's a lot of consolidation happening, and there's a real driver behind this. At present, if you want to build a new mine, so if you're an existing producer trying to build or a developer trying to get an asset up, it's an expensive period. People are expensive to get. There's not many people. Long lead times are long. commodities for actually building infrastructure are expensive. It's much easier to basically work off installing infrastructure. But the infrastructure we have in the West, a lot of those mills are now running short of feed. And that's why you're seeing this consolidation happen. Around our area, the big one that's happening is, of course, Genesis Mines taking on the Gwalia asset there around the Leonora region. And I think that's going to expand throughout a region, which is already starting to occur, in my belief. Within range of our projects over in the Western Australia, we've got roughly 20 to 23 depends how you measure it, million tonnes of installed capacity for milling gold. That infrastructure is only at present around about 80% utilised, and that's excluding those mills which are currently on care and maintenance, which there is a fair few in the region. So these mills need feed. I think that's the key theme I'm going to drive home a few times. Okay, so just going on to what I'd call our flagship project at present. This is in the Justyn Belt. So the Justyn Belt is primarily controlled by Regis Resources. So the northern portion, that's Regis Resources, roughly a 300 to 350,000 ounce gold producer. We have the bottom portion of the Justyn Belt. All the major structures which host gold propagate down into our ground, and they're the structures which we're currently exploring at present. It's a pretty large land package. You've got just under 300 square kilometres. And we've got multiple targets which we're exploring at present. I'll just cover off on 3 of those very quickly. Okay, what I'd like to highlight here is these 3 prospects, 3 of a very large portfolio prospects in this tenure. My belief is there's 10 million ounces been discovered in the north, in Regis's ground. Our ground is very much underexplored. I'm sure we can yield at least 1 million ounces or more. Given the scale of these gold anomalies, they very much have the ability to host them. So the first one there, Southern Star, is our most advanced. The key takeaway here is this is 700 metres long of mineralisation, only drilled very shallow to about 140 metres below surface. But some great intercepts in there. So 68 metres going just under 2 grams, 69 metres going 1.1, 59 metres going 2.1 grams. So very consistent ore body. And this hangs together very well. We probably could announce a small resource on this, but I think it's premature. It's open in every direction and we're still drilling. Golden Boulder, we put an announcement out just recently. So Golden Boulder, a little bit closer again to where Regis' existing mills are. Again, very low stage, but some recent air core drilling came up with some great results. An example of that is 5 metres going 3.3 grams, including 1 metre at 12.3 grams, 4 metres going just under 7 grams. So really high grade potential here. But the key is there's about 4 kilometres of historic workings. So there's over 50 workings over this Golden Boulder target. And these are workings where there's real gold pulled out. There's announced production going back to, say, 1901, 1902, all very shallow. This is all ahead of us to drill out. 4 kilometres is a long strike length. And we've got 3 gold trends, which we're currently exploring. Finally, Amy Clark, a little bit lower in the I suppose, development portfolio, but we've got 5 kilometres here of anomalous gold, which we've picked up in shallow air core drilling or geochemical anomalies. Some of the air core picked up some nice high grades again, 8 metres going 6.7. So you've got 3 prospects amongst the portfolio, all of which have got propensity for high grade and certainly got that strike length and capability of hosting within each one 1 million ounces or more. We'll see when we get the drill bit turning. Okay, and just going to shift over to this part of the world. We put out an announcement this, excuse me, we put out an announcement this morning, just bringing this project more to the forefront. We've been relatively quiet on our Queensland project, not by lack of work, but just by building up a body of work behind us. So over this part of the world, we've got the tenure that completely surrounds the Mount Carlton mine. So Mount Carlton mine, over the last 10 years, has been a very solid producer, very good revenue earner. It was Evolution, it most recently became Navarre. It's probably coming to a bit of a hiatus, but there's certainly much more gold to be found there. Interestingly or surprisingly, our ground, which surrounds there, has got very little exploration to date. So very little drilling, and this is extraordinary. In the West, ground that's within QE of a 1.7 million ounce equivalent gold mine would be really drilled heavily. That's not the case here. So very under drilled. To date, we've picked up 29 targets and we're chasing, so these are the elephants. It's big, low and high sulfidation epithermal systems, porphyry systems, or intrusive related gold. So these are big systems, potential to host multi-million ounce deposits. We've got 29 targets. one thing we do recognise, we really want to be the guys who put the first drill hole in and make that big discovery. But in conjunction, we're also aware that, you know, it can take some funding to drill out this style of project. So in conjunction with getting our exploration going in our own right, we're also looking for partners. So that process is ongoing at present. The announcement this morning, the theme was, look, we've narrowed down those 29 prospects into the 5 highest priority. I won't go through them individually, but all of these have big scale, multi-kilometre potential. You know, you're talking about 700 metre zones of stock work, which is amazing. You know, beauty about this state you've got here is you've got real geology, interesting geology outcropping at surface. In the west, a lot of that's undercover. Amazingly though, it hasn't been drilled. So, you know, Queensland is a real frontier, I believe, at the moment for exploration, particularly for gold, silver, porphyry, epithermal style mineralisation. We've also got Leichhardt Creek, what, 3 kilometres of stock work from surface. And I'll show you, actually I'll finish off on a picture just after this, just showing you what we like about this, this region. You know, in areas like Sledgehammer, where rock chips are picking up bonanza gold, 47.5 grams per tonne from surface. So this is the targets which we're going to be really sinking our teeth into over the coming years, and very much in the near term as well. So I think it's important to finish off on something a little bit pictorial, but just from left to right there, I take it there's probably a few geos in the room, but not a great deal. But these are sort of rocks that really excite geologists. So what you're looking at here, this is our stockwork veining. This is from our, what we call our Megan veins area, epithermal style. So multiple rock chips in this area. This covers a vast area, are going above 1 gram per tonne from surface, up to 10 grams. I think this might be a piece nearby where there's 10 grams per tonne at surface, gold. This rock in the middle, we've got 3 kilometres of strike length of this epithermal veining. So these veins here are filled with quartz and pyrite. All the staining is a result of sulfide. We know sulfides host most mineralisation in terms of copper, silver, gold, often in conjunction. And then finally on the far right, a pretty little picture of an area we call Red Rock in the Molongal area. And obviously the green-blue colour, it's actually more green than blue, but that's oxide copper, and there's very high silver background in this. And this area has not been drilled to date. Very little work has been done. Okay, I'll leave it there, but look, just to highlight, we are a company with skin in the game. You know, we're, I believe, very undervalued at present. We own all our projects 100%. And importantly, all of our projects are within 40 kilometres of existing mills. So we can find resources, but we don't have the onus necessarily of building infrastructure. Of course, we are, unless of course we find the big one, in which case, you know, we're certainly going to build it and go ourselves. Thanks very much.
Thank you. Matt, did anyone have any questions for Matt? Because he's managed to finish 5 minutes before his allotted time. So I think he should really get his money's worth. Does anyone want to ask any questions of him at all? Would you like to go and have a drink with him at the end of the day?
Please come and visit the booth.
Go and do that.
Intentionally before time. I know the afternoon we can get a bit dreary after our a big lunch, so go quick. Thanks very much.
Good on you, man. Thank you so much. Right. Now, here's something I didn't know about during the lunch. I went and had a chat with some of the peoples out there. I did not realise that back in around 2005, the number of geologists who had a particular bent towards uranium, in fact, who were qualified to sign uranium resource estimates, it's called a JORC, was, how many do you reckon? Out of all the geologists, the talented geologists we have in Australia, how many do you reckon were actually able to sign these special things? 8. And this fella here was one of the magnificent 8. So he knows his stuff. Yeah, give him a clap. He's done pretty well, actually.
Thank you very much.
Very well respected and regarded. So a couple of years later, about 2021, just before the price of uranium went a little bit upwards and mad, he and a couple of mates had a bit of a, well, they had a think about it, what was coming in the future. And I thought, right, we are going to put together a uranium exploration company. So Terra Uranium was born. It's actually celebrating its 2nd birthday this weekend. So another round of applause. He's done one there. Yeah. So what we want to know is, what are you going to offer us as an investment opportunity? That's the big thing, because what he did beforehand was he showed me a graph, you know, where you make money as an explorer, how it goes like that. He showed me the little curve and he showed me where they are. To me, that looked like potential to make money. But let's listen to him and hear what he has to say. Would you please put your hands together, everyone, for Andrew Vigar, the chairman of Terra Uranium.
Thank you very much, everybody. Is that coming all right down the back there? I've got a blazing light right in front of me. Terra Uranium is 2 years old this weekend. We listed on the ASX 8th of September last year. So we're a new company. We're an exploration company, a discovery company. So we're based in the Athabasca Basin. We're one of only 2 uranium companies speaking here today, and I know Andrew's up next. I'll give you a little bit of rundown on the uranium business. Is anybody familiar with uranium? Anybody like to invest in it? Am I wasting my time? No, that's excellent. No, we as I said, we've been in uranium a long time, but this company was formed by myself, Darryl Clark, Troy, Doug, and then Kylie came in, very much focused on discovery of tier 1 deposits in the highest and richest grade province in the world. There's nowhere that compares with the Athabasca. The deposits like Vigar and McArthur River are the largest and richest by a big margin. And there are not only are there mines in the area, there are mills as well. The first thing we did though is guys like Troy and Doug and also Mike McClelland, our exploration manager, they're all local Canadian Saskatoon boys. So if you like, we're a Canadian company listed on the ASX with a couple of Australians at the top, but all our operational team are in Canada. All our projects are 100% owned. So there's our board. We've got the team down the bottom, they're all Canadians as well, all very highly experienced uranium people. So our Canadian team led by Mike and Jennifer, our exploration manager, these people have been working uranium their whole lives and their parents before that. So this is a very experienced team. As you mentioned earlier, Chris, this is a bit of a slide I like to put up here. I don't take credit for this. This is off Visual Capitalist. It's called a Lassonde curve. We did talk about this maybe 10, 15 years ago in Hong Kong. For investors, that's where we are. So Terra Uranium is sitting down at pre-discovery. So we're a discovery company. My view is, as an investor, there's only 2 times that you make massive gains as those up areas there. One is on discovery. The other one is when you put a mine into production. Everywhere else you lose money. I'm sorry to say, that's what happens. You do an awful lot of work after a discovery, feasibility, building a mine, and all you'll find is your values go down. When you actually produce something, then you're genuine. People believe you'll be the next Rio Tinto or the next BHP. We're at the pre-discovery stage. This is a little bit of a chart. For those of you who aren't familiar with the uranium market, and I'll give a little bit of an intro for Andrew as well later on, same market. This goes right back to the end of the Second World War. And what this is showing is basically when we started to actually produce uranium in any quantities, the actual amount produced and where it came from. The big key point to note there is around 1990, when there's a sudden massive shift, and that was the collapse of the Soviet Union. And what happened after that collapse was a lot of weapons grade uranium was coming back onto the market, onto the secondary market, to be reprocessed back into power generation. And that completely changed everything. And all of a sudden you see Canada coming up there. And don't forget Australia. Who knows that Australia's a uranium producer? Come on, put your hands up. A few of you. Good. But did you also know we're the 3rd largest in the world? Yes, and we don't have any nuclear power here. It's crazy. But we are the 3rd largest nuclear uranium producer. Most of it comes now from Olympic Dam mine in South Australia. And then there's some small shallow ISRs as well. But the big note on this chart is that pale blue area, which is a country called Kazakhstan. Now, Kazakhstan's in Central Asia. It's the largest producer in the world, but there is no uranium coming out of Kazakhstan at the moment. And it's because of the sanctions on Russia because of the war in Europe. And that is not going to change, everybody. That's the way it's going to be for a long, long time. That uranium will be going to Russia, it'll be going to China, it'll be going to other places in Asia, won't be coming to the Western Hemisphere. That's why we focused on Canada. This is a nice little chart here. The top one is from my old company, Alligator, but it's, again, a timeline from 1970 through to 2018. And you can see those major deposits that we're chasing, like Vigar and McArthur, were found back in the 80s. And they were massive deposits, but they were getting deeper into the basin. And then the only recent one is Arrow, the one on the right-hand side, which is in basement. It's outside the basin. And it's a very, very large deposit, but relatively low grade. You'll see on that chart below, it's sitting at around 5%. These are the ones we're chasing. MacArthur Rivers and Cigars, 15 to 20% uranium. In other words, a fifth to a quarter of the rock is actually uranium ore. These are just unique deposits. There's just nothing else like them in the world. They're very small in area, but they're very high in grade. This is another slide I'd like to put up. The next question was, why isn't anybody exploring out where we are? And the reason is pretty simple. It's a little bit deeper undercover. It's a little bit deeper in the basin. Why is it worth looking today? Because of what Denison. So this is from a company called Denison. They're a mid-cap operating in the basin. They've got the Phoenix deposit. They're mining that by the same methods that we use for mining the shallow ISR type deposits using solution mining. This is a major change because we can do this at 800-900 meters depth without any problem. Increase in cost, somebody asked me this last week, I think it's around 20% over mining it at 500 meters. It's not very much. This is in our slides. That slide over there is from Denison. There's a whole lot of rubbish I had to put down the bottom for the stock exchange. It's not ours. But the important thing to note there, CapEx for a project that's producing around 5 to 6 million pounds of uranium per annum, CapEx is around 300 million, all in sustaining costs, which is your initial cost plus all the capital going into the project, less than $10 a pound uranium. Remembering that uranium is now nudging $60 a pound. So in other words, this deposit, when it goes into production, will be incredibly profitable. But more than that, it has a very, very small ESG footprint. So its footprint on the environment is very small because there's just a series of wells. And when the well field's finished, all you're left with is some well stems and a forest. There's no open cut, there's no underground mine, there's no big towns, there's very, very little impact on the environment. And we are very, very big on ESG. So getting to a little bit of a timeline, we mentioned that what we'd managed to achieve in less than 2 years. So all these dots are all the things that we've done in a very short time. And this is really due to the quality of our technical team and the ability we have to plug into the services that are available in a place like Saskatchewan. You have drilling companies, you have contractors, you have skilled geologists, but you need to know who they are and how to get to them. And we do that through our personal connections, through our board and management. And now the top right-hand one, we're drilling. So we're drilling our first diamond hole at the moment, and our second one will kick off in a week or two. This is a pictorial representation of the sort of work that we've been doing. So we call it stacking. So we start with our target, which is in the bottom left corner there at the unconformity. So we're chasing those unconformity deposits that are sitting at the unconformity or just above. As I say, very unusual geological environment to produce extremely high-grade deposits. The deepest seeking method we use is called ZTEM. It's a type of airborne EM, electromagnetics. We do structural analysis of the basement. We pull all the historical geophysics, magnetics, gravity, other analysis together. We also brought out from Australia with Fleet Geoscience. I know they're around the conference today. This is an Australian adaptation of what we call passive seismic. So this is another way of measuring physical properties, but it's done using a passive seismic, so there's no explosions, nothing else. And it uses the Earth's own very low frequency vibrations to measure surfaces. We proved that we could actually map that unconformity surface at 900 meters below surface. It's a long way down. VTEM, another type of EM, looks shallower, and then geochemistry at surface, particularly helium. Helium's a decay product off the uranium at depth. A lot to take in 15 minutes. They're our big targets. I might go to the next slide because it shows a little better. This is the reason we chose it. That big grey zone running through there is called the Cable Bay Shear Zone, which has been known about since the 50s. It's a major structure that cuts the Athabasca Basin and therefore provides us the structures we need to bring the ore fluids in. We pegged that ground ourselves 100%. We're now completely pegged around. So there's no vacant ground in that area at all. The people around us are the likes of Cameco, Orano, ISO Energy, OSCO, a couple of others. But more importantly on this diagram is that if you find something, you've got to be able to treat it somewhere, and a uranium processing mill will take you 10 years to permit. So even after you find something, it's going to be 10 years before you can do anything in a virgin location. We have 3 major mills here, owned mostly by Orano and Cameco, which have excess capacity and will take anything we can find. And we're less than 100 kilometres trucking distance from those mills. So a lot of people, and we'll be talking about, others are talking about other commodities, gold, nickel, talking about parallel belts of mineralisation to known belts, and no one's gone out there and had a look. Well, we're out there looking. We'll quickly run through a couple of our projects. Passfield is our primary project. It's in the centre of the area, just north of Passfield Lake itself. Our targeting there is based on stacking. That middle grey area is the ANT, where the first time it had been used in the Athabasca Basin, and we proved it worked and matched the unconformity. There's a depression there, which we think is caused by alteration, but extremely strong responses from both ZTEM and BTEM. And also, we're getting shows of helium at surface. So that's where that drill hole is targeted. That'll be the second hole we're drilling, and that will be starting next week. Our second project is Parker Lake. It's right on the cable bay structure. We got some very strong conductors here, perhaps not as strong as at Passfield, but we decided to drill this one first to test our drilling techniques. It's no small thing drilling a 1,100 metre hole with a helicopter transportable rig. I don't think you could do it in Australia, but it's been a major exercise. That hole's going down now. It'll be completed the next day or two. And again, we don't have ANT here, so we're just going into a straight conductor. And our third project, Hook Rock, it's the shallowest. We're up at about 400 metres depth, and it's up in the northern part of our tenements. We haven't accessed into this area yet. We're still discussing with the First Nations to access that area. A little bit of a note on on helium. As we said, Tom Kotzer, who's world recognised specialist in helium detection for uranium, is indicating that the sorts of results from old drilling, 1979 drilling, in the Passfield area is as good as we'd expect from a major deposit. We'll be drilling that one next week. A little bit on nuclear power. It is the coming thing. It will come to Australia. I hope to see it in my lifetime, but we shall see. It will definitely come. And just to finish off on ESG, I can't emphasise this enough. If you don't have engagement with the local people in your area, you are stuffed, because they will really cause you grief. If you want to know what it's like to operate under a treaty, we operate under Treaty 10. So we are in a treaty area. Australia's talking about going to treaties. To be absolutely honest, it's no different to what you would be operating in under Australia under native title. It's almost the same. Deal with the local people, respect them, and we did. We sat down with them before we were even listed, and said, is it all right if we come into our area, your area, and do exploration? If we find something, it'll be minimal impact. So yes, they support us, and we have their people working on our projects. There you go.
Thank you very much.
Did we hit the time mark all right?
You
36 seconds.
You made it with a minute to spare. And like we said, the 15 minutes wasn't long enough at the start, because that was quite interesting, everyone, wasn't it? Educated and investment potential as well. The way that you showed it, I think that was quite convincing. But remember, you have to do your own research. So please go and do your own research. But it certainly sounded like a really interesting journey to jump on board with. So thank you, Andrew.
That's very kind. Thank you. You come around to our booth later and we'll have a chat.
Yeah, that's it. Go and have a chat with him.
Next, Andrew will tell you more about your own.
All right, we've got another Andrew on now. So 2 Andrews, and they have not just their name in common, they have the mineral that they love in common as well. This is Andrew Ferrier. He is a managing director of Okapi Resources, which has exposure to both uranium development and also to uranium enrichment. So the company has uranium projects, or do I say projects? Yes, I do, in Canada and the USA. And I suppose really as North America really embraces that carbon-free energy, Okapi has invested in uranium enrichment to gain access to what they see as a multi-billion-dollar market. Does it have an upside for you? Let's keep going on this uranium journey. Make him welcome, please.
Thank you for the kind introduction. My name's Andrew Ferrier. I'm the Managing Director of Okapi Resources. Very much following on from Andrew's presentation, we'll be talking about uranium. And I think what I'm trying to achieve over the next 10 minutes, time is short. So what's the key message I'm trying to get across? I think the first point I'm trying to get across is, and you don't really hear it or see about it too much here in Australia, but when you're across in North America, what's happening in the nuclear markets across the globe, the changing attitude to nuclear energy globally, and particularly what's happening in the US from a geopolitical point of view is very important and relevant to the Okapi story and the company we're building. And then it's we move on to the assets. I spoke here 12 months ago. I also want to tell everyone what we've done over the past 12 months. We've been pretty aggressive on numerous fronts, but also what that means for the next 6 months and what we're trying to achieve. So Okapi is changing. We're across 3 different pillars, right? The first is building a series of uranium projects in the US, and that's largely where the skills expertise is. And we're very much, like Andrew said before, we're an ASX listed company and we've got a few Australian guys at the top, but the reality is all the heavy lifting is done either in the US, the guys are based out of Colorado, which is closest to our assets, and then out of Saskatoon in Canada. So we have our US assets, which we've been advancing, put out announcements this morning on how we're advancing our key asset, which is our Tallahassee project. It's one of the largest uranium resources in the US. We also have 6 projects in the Athabasca Basin, high quality exploration projects, which we have been systematically advancing and prioritizing. We've gone and done rock chip samples. We've then gone and done our airborne surveys, which we announce to market shortly. And we're rapidly preparing to drill this North American summer as well. And very excited about that discovery curve. And then on top of that, we also have invested into a uranium enrichment company, which is incredibly unique and obviously incredibly exciting for us. Uberian is the name of the enrichment company. It's a private Australian company, and it's commercializing an enrichment technology down at ASNO in southern Sydney. And we can talk more about that. But the uranium market is where we have to start. And everything you see in the news these days is very positive for nuclear. The world has woken up and realized that nuclear really is the only form of clean baseload power. And the US is at this crucial point in time where, nuclear still accounts for 20% of all its electricity production. 20% is a big number for the world's biggest economy. It has 93 operating reactors today, more than any other country in the world. But what's changed in the US over the last 12 months is it's woken up and realized that it imports all of its uranium from overseas. And you can clearly see the 1980 timeline and what happened there in terms of the uranium market changing at that point and all the Kazakh production coming online. And for a long point in time, the US utilities who acquire the uranium that goes into nuclear reactors were very happy buying cheap uranium out of Kazakhstan. That all changed 12 months ago. This is no longer an acceptable way for these US utilities to be fueling their nuclear reactors. There's bills in the US Senate as we speak talking about banning uranium from Russia. And that will leave countries like the US scrambling to find uranium production like in their backyard where we're based and we have some of the biggest projects, but they'll also try and source it from places like Canada and Australia. Only problem there is building a uranium mine takes 10 to 15 years, right? And there's existing projects like the ones we have in the US that can be fast-tracked into production. US governments are very good at throwing money at problems, and this is what they're doing so far. I won't reiterate some of the things they've done over the last 12 months, but I think the key point to say is nuclear energy is now very bipartisan in the US, and there's so few issues in the US which Democrats and Republicans can agree on. But at this point in time, nuclear energy is very much one of them, and they're throwing money both into their nuclear reactors to make sure they're economically viable for decades and decades to come. But they're also very concerned about the enrichment space as well, which we'll touch on. And this is where the uranium markets are at this point in time. On the left, you can see the uranium price, which is the U308 price. This is the uranium that uranium mines produce that then go into the conversion enrichment process to be turned into nuclear fuel. And on the right, you can see the enrichment price. So this is the SWU price. This is the price effectively at what enriched uranium sells for. And what you can see here is, one, there's a very clear point in time where Russia invaded Ukraine and what it's done to the market. But what you can see probably most importantly is the uranium prices come a long way in the last couple of years, but it's got a long, long way to go for it to actually incentivize new production, a significant amount of new production into the market that will allow basically the supply deficit that exists in the market today to be fulfilled. Most new uranium mines, then incentive price of around US $75 per pound. So the uranium price needs to get to that level for it to actually fix the problem. And the reason why, you know, it's still got so far to run is basically uranium space has been so underinvested in over the last decade to multiple decades. And that means there's just no new uranium mines which can be put into production. There's a few care and maintenance mines which were mothballed in the last uranium boom, but they are insufficient to fill the growing demand for uranium worldwide. You know, China, India continue to build nuclear reactors. Uranium is growing at a much larger rate than most people aware here in Australia. These are Okapi's assets. Mentioned this before. As you can see, the three assets we have in the US are our Tallahassee project, which is based in Colorado. We have a 50 million pound resource on that project today. We just announced we submitted our permit, which is an exploration and development permit, which will allow us to carry that project forward very swiftly from this point in time. That accumulated in about 6 to 12 months of work in terms of locking down the mineral rights down at a key deposit, which is the Hanson deposit at Tallahassee, and locking in land and surface access agreements with the landowners in the area. So it was a big milestone for us and allow us to get more and more news out on Tallahassee moving forward. The next asset we have in the US is our Maybell project, produced over 5 million pounds of production historically at grades of over 1,300 ppm. We have the substantial position of that whole Maybell project. And we've been working very hard on that, stitching together old historical data, and we're putting that news out to the market shortly. We also have a very interesting position in the LaSalle district of Utah. This is only 80 k's north of the White Mesa Mill, which is Energy Fuel Zones. It's a conventional mine. Energy Fuels own a large portion of the districts. And you talk and look at Energy Fuels, which is a $1 billion US listed market company, when they talk about going into production, when the uranium price gets to where it needs to be, the first place they're going to say is back in their old LaSalle mines. So that's where we want to be. I'll touch on Athabasca when we get to the next slides. This is where we are today. We're the little blue column on the very left. I'm not sure if you can even see it. Yeah. What we've been doing over the last 12 months is setting us up so we can move rapidly to the right. And it's a little bit what Andrew was referring to. We sort of play it in two ways. We obviously have the discovery potential of us drilling in the Athabasca Basin. The Athabasca Basin is elephant country. If you snag a discovery in that part of the world, it's a game changer for you. But we also systematically are developing our US assets so we can go from this explorer stage that we've advanced explorer stage that we're self-taught ourselves across into this development phase. And announcements like we put out today at Tallahassee is just one step in that process. You can see on the bottom right there is the sort of the resource pounds that each of those companies have. And some of it's not relevant for the Athabasca producers at this point in time, but some of it is. And it gives you a sense for how large our resource base is relative to other companies with much larger market caps than ourselves. And this is our Tallahassee project. Huge amount of time and money has been spent on this project over multiple decades. The Hanson deposit, I'm not sure how to get the light up here. Hey, the Hanson deposit is this kidney-shaped deposit here. Cypress Swiss cheese, the asset back in the 1970s, got a full-blown mine permit to operate that as an open pit and underground. And effectively, after the 3 Mile incident in upstate New York in 1980, walked away from the project. We are blessed with having nearly all this information and all this drill data, which is an incredible head start on the project. We've gone about continuing to consolidate the district. We, as I mentioned before, now lodged a permit on over both Hanson here and Picnic Tree. We'll quickly follow that up with another permit over Taylor and Boyer, which are the assets to the north. But as you can see here, there's been a huge amount of historical drilling, huge amount of historical mining also on this asset. And the whole district itself is around 90 million pounds. 90 million pounds in the US. Hopefully, given what I sort of tried to explain to you previously in terms of where the US is at from a geopolitical point of view and their desperate search for energy security, this makes Tallahassee a pretty relevant asset moving forward. These are our Athabasca assets. So one of Andrew's slides was a fantastic slide. I talked about his sort of systematic advancement and prioritization of projects. And I kind of wish I had it in my side because we've followed a very similar track to that. We've gone out, we brought these projects 18 months ago from a TSX listed company. We've used, world-class consultants to effectively re-examine all the historical data, prioritize the projects, but then we've gone out systematically, put geos in the field in September last year to do geochem, match structures. We then completed an airborne survey over the project in the last couple of months. We got that news out to the market 3 weeks or so. And basically it's confirming and reconfirming the high priority targets that we have. We're now working towards pretty aggressively drilling out this Newnham Lake project up here that you can see in the northeast of the Athabasca Basin. It's slightly different approach. We are looking for basement style hosted deposits. And because we're on the fringe of the Athabasca Basin here, we can sort of drill into those basement style deposits within the first 50 to 150 meters of all the drilling that we're doing. And we look, obviously, as I mentioned before, currently planning to be drilling these projects hopefully in August this year before the onset of the North American winter. So that would be very exciting news for the market. And we're sort of taking every step to make sure that we're drilling where we want to be drilling and give ourselves the best chance of discovery. Now on to Uberian. This is the enrichment story. We announced we were investing in Uberian earlier this year. Very excited to be able to do that. It's very difficult for small companies like ourselves to give our shareholders exposure to this enrichment landscape. And enrichment in the US is a little bit similar to the uranium market, where the US is now nearly completely reliant on enriched uranium coming out of Russia to feed those nuclear reactors. And this obviously isn't sustainable moving forward for the US government. And in particular with the onset of small modular reactors, which I think a lot of you have heard about. It's basically a miniature nuclear reactor. But the thing about small modular reactors is they acquire enriched uranium about 3 to 4 times higher than the enriched uranium that goes into a nuclear reactor. And currently, there's no commercially available facility to produce enriched uranium at those levels for small modular reactors, which is effectively holding up the whole progress of small modular reactors. But for a long time, and currently all enrichment occurs through centrifuges, which is an old technology with moderate efficiency. Most people are aware of Silex, which has the 3rd generation technology. Silex is an ASX listed company with close to $1 billion market cap. What Uberian has is different to those two technologies. It's a chemical technology. They're working down at ANSA and progressing and commercializing that technology as we speak. Okapi is a 22% shareholder now in Uberian. I've joined the board. It's going to be a pretty interesting 12 to 18 months as they continue to progress that technology. This is my last slide, and it's basically to try and give you a snapshot for everything Okapi is and why that's relevant over the next 6 months. So we're quite unique in the fact that we're in exploration. We've got our assets in the Athabasca Basin. We're in development. We've got our Tallahassee and Maybell projects in the US. And we're also now in the enrichment space as well. And us covering all those 3 different blue circles obviously sets ourselves up for where we think the uranium market's going to go moving forward. Thank you.
Right on. Thank you, Andrew. have done. Oh no, I haven't done. It's just a temporary, definitely not a lithium battery, isn't it? One of those old-fashioned batteries. There we go. Thank you so much, Andrew.
problem.
Appreciate it. Yes, you're dismissed, sir. Jump off the stage. Coming up, before we wrap up today, we've got coming up a bit later on the fastest growing oil and gas company on the ASX for you to hear from. We've also got a really interesting MD and CEO who's got a key focus on the transition of our energy system and his commitment to lead his team to strike net zero by 2030. And he's an interesting fellow because he may look easygoing, but his background is actually as a former Australian military officer. So he knows how to organise a team and lead a team, and he's pretty centred on his goal. This fellow here, Justyn Wood, come and join us, sir. He is the co-founder and the CEO of Noble Helium. Now, Noble Helium has 4 primary helium projects within the East African Rift system in Tanzania. So Justyn successfully led the first oil and gas discovery in the East African Rift for Hardman Resources all the way back in 2006, and he's hoping to emulate his success with a slightly newer product now, looking to repeat that with Noble. So the company is getting ready to drill its first 2 prospects at North Rukwa next quarter, and they believe that they have the potential to be company making. Let's see if it'll make your investment portfolio. Please make him welcome.
Thanks very much, Chrissy. It's good to be here for the Gold Coast Investor Conference. It's a great event. So yes, we are, just to underline, we are getting ready to drill after many, many years of hard work. So just give you a quick intro. This is really still a ground floor investment in potential and discovery and development of the world's largest primary and green helium reserve. Extremely favourable market, which I'll explain. Very, very solid team, truly unique and world-class assets. And this would be the world's first and largest green helium project. So most people, and I was in this boat a few years ago, 7 years ago, when we first set this up, and my co-founders here in the audience. This is helium is not just a party balloon filler. There is actually no technology without helium. In the last 15 years, helium has become an essential and unsubstitutable input into the manufacture of semiconductors, which means all the chips in your phones and cars and TVs and computers can no longer be made without helium. It's a critical raw material, effectively. It's also essential for the functioning of MRI machines. So about 20% of the world's helium goes into making MRI machines work. It's critical for rocket launches. So we've actually had, which is obviously a big growth area, and SpaceX has been in contact with us a couple of times asking when our helium is coming online. It's also important for critical for optical fibers manufacture, and I'd like to say that between optical fibers and semiconductors, helium actually underpins the entire global telecommunication system. So it's a little bit not just a party balloon filler, it's actually quite an important critical raw material. And I guess there's massive demand coming, certainly from the semiconductor space. So 15 years ago, 0 helium into chips. These days, it's 22%, growing fast. And there's a coming boom, as everybody will be aware of ChatGPT now and the coming boom in AI. So all of those chips, that are the high-powered chips that are required to run that, will be these high-end chips that require helium for their manufacture. TSMC, arguably the world's most important company, is relocating its manufacturing base out of, or in the process of relocating out of Taiwan and into the US and Japan and Korea to build these high-end chips. So demand for helium is very robust. It's currently a $5 billion US per annum industry, wholesale, so not retail. This is long-term supply contracts, and we're expecting that to grow to sort of $8 billion by the end of the decade. There's certainly plenty of room for us in what we're doing in aiming to stabilize and grow and support the global helium supply, which is extremely fragile. So last century, 100% of the world's helium came from the US. That's now more or less depleted. There is still some being produced, but the US Federal Reserve that was built up during the Cold War, because the helium was critical for launching missiles, that's now been, the US government decided it wasn't in the helium business and sold out and depleted that reserve. So that at one point, not that long ago, was supplying 30% of the world's helium. Now it's completely gone. Countries such as Russia was due to come online last year to help fill that gap. and it will. Qatar produces about 30% of the world's helium, Algeria about 8%. So between those three countries, about 60 to 70% of the world's helium will be produced, this critical raw material, by the middle of the decade, assuming Russia does come online. They had a plant blow up just as they were getting commissioning early last year, and then Russia invaded Ukraine. So that helium is not coming onto the market anytime soon. It will eventually, but with not for a while yet. So it's important that we decouple from these geopolitically risky countries and provide a diversified supply base for this material. So as I guess the important thing to realize as investors is that it's incredibly valuable. So 10 years ago, or in the last 10 years, with the depletion of the US Federal Reserve and effectively US government mandated pricing for helium, we're transitioning to market price. So it's now 4 times, it's quadrupled in the last 10 years and doesn't look like it's letting up anytime soon. 50 times the price of LNG, and a very similar exploration and development cost per 1,000 cubic feet to find it, but the product's 50 times more valuable. So it's hard to find. It's very rare to find it in commercial quantities, but if I think we've got the right geology here, this should be extremely valuable. Oops, sorry about that. The team behind it, and I'll just keep an eye on time here. So a very solid team. Sean Scott came on as our executive chairman at IPO last year. Many of you may know Sean from his days at Arrow Energy. He led the company from a $20 million startup to a $3.5 billion takeout by Shell PetroChina. Myself, and as an explorer, I've worked all over the world and run exploration projects in different parts of the planet, and I guess relevant to this, and been quite successful in it. And I guess relevant to this story is that led the team at Hardman Resources to the first oil discoveries in the East African Rift back in 2006, which precipitated Tullow, our partner in the project, buying the company for $1.5 billion. Very solid team with Andrew Garnett. He's the director of the Centre for Natural Gas at University of Queensland, former Shell and Shell and Schlumberger senior executive. Eddie Keane, who's here in the audience with CPS Capital, and Kent Masters, who used to run half the planet for Linde, the world's biggest industrial gas company, and also the entire planet for helium. Kent came on with us in 2019 and invested quite a significant amount of his own money because he understood what we were trying to do. I guess Kent's better known these days as the CEO, president, and chairman of Albemarle, the world's biggest lithium producer. So I kind of like to joke that, yeah, lithium's good, but the smart money's actually in helium. And then also we're working with some of the world's leading helium, or 2 of the world's leading helium geoscientists at Oxford University and Durham University through Global Helium Resources. They built an atlas for us. That was one of the first things we asked them to do back in 2018. And also have given us, working with us now in the Rukwa Basin in Tanzania, where we're working. So onto our projects. This is the East African Rift, or this is Tanzania. We've got 4 project areas in the East African Rift in Tanzania, arguably the world's best untested helium system. The reason it's prospective is we've got helium coming out of the ground at up to 18%, which is like multiples above sort of normal. Extremely prolific helium producing system as a result of this 2 to 3 billion year old piece of continental crust, which has been generating helium for 2 to 3 billion years. And now it's caught up in the East African Rift system. The heating and fracturing associated with that under the rift basins in which we're working is the reason this is such a prolific system. And we now know, thanks to the work that Tullow did after they bought us out, we now know where the best places, and the work that we did in improving the first oil in the East African Rift, we know where to go and improve and look for helium instead of oil and gas. So we're getting ready to drill. This is the exciting bit, 7 years in the making. We've just recently completed a $13.5 million capital raise. We're about to drill Mbalele, which is just the first of our 10 targets, just in the first basin of the 4 that we have. Collectively between Mbalele and Kachinga, and we're still working the data. Mbalele, we're targeting 16.5 billion cubic feet, which doesn't mean anything. That's for most people, but for reference, it's about 2.5 years supply of helium on a mean outcome. And that's about $7.5 billion worth of helium in the ground, just in our first wells. Immediately to the south, the Kachinga Dagar structures that we've now worked up have come in even larger at 22.5 billion cubic feet. So collectively, just those two structures, we're chasing around $18 billion in the next, well, not this program, but it'll be $7.5 billion this coming drilling season. And then next year we're hoping to drill Kachinga. This is globally significant and a game changing for Tanzania as well as for the global helium supply, if we're correct, because we're only seeing helium and nitrogen in the system. This is a three-dimensional view looking at that Kachinga Vigar structures. On the right-hand side is where we'll be drilling first. We have helium concentrations in the soil that are well above background, which is telling us that there's helium in the system and it's conformant with the structure, which is exactly what we would like to see. This type of play is exactly the type of play I devised at Hardman, 100% success rate. So 14 discoveries from 14 exploration wells in the East African Rift since we first proved that it worked. So improving the helium system in Tanzania, we wanted to go and first of all target a play that we know works, and it looks like it is. This is 3D seismic side view. Now, I know it's a bit like looking at ultrasound, and I could say, oh, there's a baby's hand in there, but it's not like that, but it's similar in that the trained eye can actually see these what we call common depth amplitude shutoffs, which is like you have to stare at a screen for a long time, many, many years, and understand the physics behind it. But basically, where those amplitudes, we can see the sediments are rolling over into the basin margin fault closure. That's our structure that we're targeting. But what's really interesting now as a geophysicist is that we're seeing these amplitude shutoffs that are flat. Now, if you think of like your glass of wine, it's got wine in it and it's got gas above the wine. If you tilt the glass over like that, the gas-water contact remains flat. So what we're seeing here is, this is very good evidence that there's actually gas above it and water below in those sediments. So it's actually telling us that there's we've done our homework correctly, and we're going to see gas. We should see gas in these wells. And then what's even more important, in the surface, we're seeing helium up to 35% above background. So we've got gas in the subsurface, helium in the soil. We should see helium in these wells. All right, so I've explained that clearly, good. So it's just a matter of concentration. So it's just like a conventional oil and gas trap, except we don't have hydrocarbons. The gas is trapped in the subsurface with only nitrogen, and the work that we've been doing with Oxford and Oxford University and a bunch of postdocs tells us we should be seeing between 3 and 5% helium, which is globally, 0.3% is the commercial cutoff in the US. So it's extremely good high grades, very unique system. Assuming we are successful, it's quite straightforward to get this to market. Blacktop Road all the way back to Dar es Salaam. The midstream distributors are actually biting our arm off to get hold of this helium before we've even discovered it. They want to build the plants for us, which is great, no capex. We'll go straight into producing $450 per 1,000 cubic feet. Well, not straight into, we're in discussions now to commercialize this early. But the path to market is very straightforward. The technology is straightforward. And this is what the maths looks like if we get this right. So 850 million cubic feet a year plant, which is about 10% of the world's helium supply by that stage. $305 million capex, which we would probably only have to provide about $50 million worth of that. OPEX of $25 million a year, but at $450 per 1,000 cubic feet, that's revenue of around 380 million million dollars a year. So payback on the plant's about 10 months, and we probably won't even have to provide the capex. So even what we're targeting here is 16.5 BCF. 6 BCF is a company maker. So we feel like we've done our homework, and this is looking extremely good. Our current share price, we just completed a raise. We touched our raise price at 18 cents briefly, like for about half a day. We've bounced back up now to 22.5 cents. I and my co-founders have a lot of skin in the game, so we're absolutely committed to making this right, doing this right. I brought on a drilling team that knows how to do these wells. They drilled the wells for us in Uganda back in 2006. So we're going to execute well, and we'll see where the share price goes after this. Thanks very much.
Thank you very much. That was great. And apologies for putting you on the spot there. And I like the wine analogy. Do we like the wine analogy? That makes it easier. That's a problem. I think sometimes you're so deeply entrenched in it technically and you know your stuff really, really well. We'd love to invest, but just that clearer picture works really well for us. Are you going to watch the rugby league this evening?
I think there's drinks, but probably.
What? What did you say there? Quick, run while they're still in their chair and they can't lynch you on the way out. Off you go. Thank you very much, Sarah. Really appreciate it. And it's an interesting proposition, isn't it, everyone? Yes?
Right.
Yes, thank you.
Thank you.
Appreciate it, Justyn. Right. Next one. Always interesting from the West Coast to hear of your challenges over here with gas on this side of Australia. So our next presenter may be part of the solution. Comet Ridge is next up on stage at the showcase, led by petroleum engineer Tor McCaul. Now, Tor's credentials, they include more than, is it 4 decades? I'm allowed to say 4 decades of experience?
Close.
Yeah, 4 decades globally he's worked. He's been with Comet Ridge for 14 of those years, and he plans to bring the Mahalo hub gas assets online into a pretty strained East Coast gas market. He's currently on the board of Australian Petroleum Production and Exploration Association. He's also a holder of tickets to a box this evening for game 2. How many tickets do you have?
Well, just one for me, but
Just one?
there's a few for a few other people.
Really? Okay. Well, his car actually leaves. It's supposed to leave at 5. It's now leaving at 5:05. So let's make him welcome and see if he can make it out in 15.
Thanks, Chrissy. And I'll just apologise to Colby and Stu who are following me. I can see at least one of them down the back there. I would have stayed, but you'll understand why I have to rush out. So I'm going to talk to you about, the last 3 talks today are actually about natural gas. We understand helium, Justyn told us, is a beautiful molecule, but methane is as well. And I'll talk to you about Mahalo Hub, which is Comet Ridge's project in central Queensland, just inland of Gladstone. And I'll get a map. I get a map up here just so you can have a look at where we sit. But the green the lime green colours, if you like, are the petroleum leases, or effectively production licenses that produce about 4,000 million cubic feet of gas a day and feed the trains in Melbourne. Feed the LNG trains in Gladstone, but also supply gas into the domestic market as far south as Melbourne and into the southern states. I'll talk to you, I've only got about 11 or 12 slides. I'll finish with what hopefully is a workable well test movie slide, and I'll give you a couple of slides on the gas market just to tell you where the gas market sits right now over on the East Coast. But as you can see from this slide, our Mahalo Hub area in the top of that, those lime green boxes, is close to infrastructure. We've got a Gemini pipeline to the south of us, and we've got a big diameter Santos GLNG line to the south of us to get gas to market. In terms of the achievements over the last 18 months, we have been very busy. We're only a small team. We're Brisbane based. There's a number of things that we've been able to get through since late 2021. However, probably the biggest 5 items for us are acquiring APLNG's position in the Mahalo block so that we increased our equity. We were able to offer Santos a share of that in exchange for a loan. And so Santos and Comet Ridge collectively bought Origin APLNG out of Mahalo. Probably the biggest thing is we achieved a 1.75 million scuff a day flow rate from a shallow coal in the Mahalo area. And that's from a horizontal well, a lateral well, and it proves commerciality and producibility in the field. We booked 2P reserves, and I'll talk to you about proven and probable reserves in a minute in Mahalo. And we brought Gemini in and Orica into our project through a pre-feed study on a pipeline with Gemini, and also through an MOU to look at prepay for natural gas for Orica. I think on the East Coast now, gas is hard enough to get, or so hard to get, that I think the days of vanilla gas sales agreements are gone. I think what you're seeing now through AGL and through others is an ability for the bigger companies, the bigger buyers with balance sheets to contribute capex to projects, which then enables the GSA at a slight discount to market price to account for the capital that the big buyers have put in. So we're looking at a number of structures like that right now, where our gas buyers actually help us to fund the project. In terms of the domestic market, there's a lot of different graphs around showing that we're hitting a crunch. Victoria in particular, I think, is in trouble. The average Victorian uses almost 3 times more gas than any other Australian. Their winter consumption to summer consumption is 3 to 1. They also have 80% of their houses connected to the grid. And Victorians are probably about as anti-gas as you get in Australia. So we're seeing Bass Strait starting to decline. We're seeing a pause in the market in the last 6 months since the federal government brought out what they wanted to. They tried to put a price cap on the market, which is now effectively being unwound. But I think you're seeing a very exciting time for natural gas over the next 1 to 2 years as the supply constraints hit the market. And I say to people, you know, put your seatbelt on and tighten it up very tight, because I think it will be quite interesting. There's some quotes there towards the bottom that I think have been in the AFR in the past week or so. Government is now walking back large parts of its gas price fixing ambitions. Market intervention never works. The government started with this in December, and by February they were trying to step back from it. And I think we're now on the edge of getting back to just a normal functioning market. We need more gas. It's as simple as that. And without expansion in production, even the ACCC is saying we've got trouble in the gas market. We just won't have enough supply. If we move over to the code update, what the government did in terms of intervention in early December, it's caused a lot of uncertainty in the market. I have a lot of shareholders ring and ask questions. I know it's not easy to get your head around if you're not in it all day, every day, as we are. But basically, the announcement in December that they would set prices based on some sort of government set rate of return is gone. The concept that there would be arbitration to determine gas prices is gone. And for small producers like us, the great news is that as long as we produce gas to domestic market, all our gas goes to domestic, then we just simply step right outside the $12 cap or any sort of price fixing whatsoever. And we're simply back to negotiating with a buyer and agreeing a gas price and moving forward. If we'd like to sell some gas to the LNG schemes, we can apply for an exemption, and everything we're hearing is that should be pretty easy to get. So the irony of the price cap that was set at $12 is it looks like it's really become a price floor. And a lot of people, anyone who's done any sort of real economic theory understands that just let the market function, let it find its happy equilibrium point. As we move over to reserves, just a couple of quick slides on reserves. 2P reserves are proven and probable. That's what we can sign a gas buyer up to. We've seen a decent increase in 2P reserves, nearly 30% over the last 12 months. We started in June last year at 106 in proven and probable petajoules of 2P reserve. Our acquisition of Origin's APLNG share of Mahalo took us up almost another 50. And then our own well test and success last year with the reserves booking from our own 100% block Mahalo North took us up another 40. So we're sitting now at 195 PJs of 2P, which is a reasonable amount of gas to be looking to plug into the market. If you include our 2C, our contingent resource, that number pushes up to 406. That's the slide at the top there that I guess on the left, the box is our reserves and resources table that shows that 2P plus 2C truly equals 406. We also, late last year, booked some 2C and 3C contingent resource. So we've been able to increase the contingent resource, and over time, as we go and flow, do pilot testing and drill core holes in that area, we would expect the 2Cs and the 3Cs to move across into the Ps category. The map is probably interesting just in explaining the project and the equity. The grey Mahalo area in the south is the joint venture we now share with Santos. This is the area we bought APLNG Origin out of last year. Comet's now 57%, Santos is 43% an operator. To the north of that, we have the 3 orange boxes, blocks if you like. They're 3 wins we've had in competitively bid tenders in the last few years with Queensland Government, and we won them 100%. So the big Mahalo hub project area now is almost 1,900 square kilometres. The grey stuff is one we participate in through our joint venture with Santos. The orange is Comet Ridge 100%. And we're pushing very hard right now to get the box that says number 2 in the northwest online. We've done a lot of environmental work this year. We're bundling up that and writing it up, and that'll be submitted to both federal government and state government in third quarter. And we'll be looking to get all our approvals back early next year and make a final investment decision, a go decision, if you like, on that block about March or April next year, leading to production in the fourth quarter of 2025. The blue dotted line, a bit hard to see, but there's a pipeline down the middle from near that two number. That's Gemini. We're working with them on a pre-feed study at the moment in a 73-kilometre pipeline. And we'll be looking to then use that to transport all the gas out of that area down into the market. And right at the bottom of the map, you'll see that we have 2 pipelines we can access. The first is Gemini's own pipeline, which feeds into the domestic market. The second one, which is less than 5 k's away, is Santos's own GLNG pipeline, which takes gas to LNG in Gladstone. So we can get gas reasonably easily from where we are in Mahalo, just inland of Gladstone, into the network to go to domestic gas and LNG. As we look at our path to production, we're establishing a very large and productive area in the Mahalo gas hub. We like having Santos there as an experienced, modular-based, low-cost operator. They're a great partner to have. And I include Gemina in that now. Gemina coming on board to look at building the pipeline for us. They've done this before many times, and they're a quality partner to have in the project. We're going to continue to add reserve and resource additions as we go, as we build out and as we bring these different blocks online and as we ramp up our production, and we're close to infrastructure. This is probably my favourite geological slide. The green U shape, if you like, is our high quality fairway where we attack first for gas production. This is where our coals are shallowest. This is where we've got 3 examples on the left in the table of wells that produced gas at very good rates. The one on the bottom was a very little lateral well, only 360 metres. We then went to a well that was 900 metres, and then finally we've gone to 1,800 metres. Santos is drilling lateral wells now out to 2,400, and there's design work going to push these lateral wells up to 4,000 metres. So we'll see increasing productivity from these wells as we drill them out. A key point there is we're very, very low CO2. With all the emissions work that's going on around Australia right now, natural gas with low CO2 is very valuable. And we've got the last couple of samples we've got from Mahalo were just over 0.1 mole%. Here we go. In terms of the JV project, this is the project with Santos. By acquiring APLNG Origin share last year, we've simplified the JV structure into 2 parties. We're both aligned. We both want the gas online as quickly as we can get it. We've extensively appraised that area. So we've drilled a number of wells as a joint venture. We've got a very, very good handle on what's happening. And with Gemina coming on board, we're now progressing our infrastructure solutions. So Gemina's a key part of that. In terms of talking about Gemina, there's a quote there from Frank Tudor, their CEO. We signed a pre-feed agreement about 6 weeks ago. We plan to roll that into a proper full-blown feed agreement in about another 6 to 8 weeks. So Gemina can take gas out of our area for us on a tariff, and that's a significant amount of capex that we don't have to go and find and put into the project. As we go through, just sort of summarising, you see a lot in the press, in the paper, you know, gas is dead. We're all going to be renewables. That's all rubbish. You need gas for everything. We need gas to make the glasses that I'm looking at you at. We need gas to make tennis nets. We need gas to make iPhones, bricks, bottles, fertiliser. 2/3 of the world is fertilised. Agriculture comes from natural gas. So if gas stops, we all starve. So gas will be around for decades. The more renewables we have, the more gas we'll need to support those renewables. So we see emissions rules making gas even more important. We're about to sign our inaugural GSA with CleanCo in Queensland. We're progressing other gas sales agreements, pipeline with Gemina, development options at Mahalo North to FID the project in the first part of next year. And we expect, as I said, first gas sales late in 2025. That's the corporate overview. We're about 16.5 cents this week. The intervention in the market took a lot off our market cap. I think we were at 19 cents and we ended up at 12. thanks to the intervention, but we're on the way back now. So we're pleased that investors and shareholders getting comfortable that the federal government's taken its foot off the gas market and we can get back to some sort of normalcy. And then if I just see, this is our Mahalo 1 flare test. As we drill these pilot wells, we need to flow them for a little while. We're not connected to pipeline. And so we well test for a couple of months. We establish all the technical parameters and then we shut it in and save the gas for the future. So thanks very much, Chrissy, and thanks for your time.
Well done, Stuart. There he goes, moving quickly out the back. Go, quick, run. You're going to make it. You will make it. What is it now? What time I've got? 5:04. You came out a minute early. Well done to you. Just a reminder too that Tor and our next two presenters. No, keep walking. You ignore me. You keep going. It's Tor and our next two presenters. So we've got Talon and our last one is Strike. And they will actually be over in Perth in September for our oil and gas. So if you're not interested in AFL, because you're not, because you're from Queensland, most of you, so you don't know about the grand final and you're interested in oil and gas, then come and join us at the Hyatt on the 6th and the 7th of September. We would love to have you. And I can give you some other great tips for enjoying our great state while you make some fabulous investment opportunities. So coming up and joining us now, this is the fastest growing oil and gas company on the ASX. They've grown from 3.5 to 120 million market caps in the last 3 years. They're morphing from explorer to producer. They've had a bit of a re-rate on the share price. Not bothering this fella here, he's still smiling. He's got his eye firmly on the prize and they aim to draw some really big prospects in the next 12 months. Colby Hauser is the MD of Talon Energy. You've worked bloody hard for this one, haven't you, Colby?
Yes.
Bloody hard. So, and he's got a really interesting set of skills, which is about this long, which I'm not going to go through individually, but suffice to say that he has got his corporate strategy, gas sales, marketing, joint venture representation. He's got project development as well as investor and government and stakeholder relations. So he's got all of it in there. He knows what he's doing and he reckons he's done it pretty bloody well. Let's listen to the Talon story and see if it's something that you'd like to be part of. Please make him welcome.
Thanks very much. I'm not sure if everyone got that sort of elaborate intro, but I appreciate it. Thanks very much. Yeah, really excited to be here. I don't think our story is that well known on Gold Coast, so thanks to Vertical Events for putting this event together. Yeah, who is Talon Energy, right? We're an oil and gas explorer and producer, I think, which is differentiates us a little bit to our peers today. We have a market cap of like $120 million basically. And so we're unique in that we're fully funded coming into production. As I mentioned, production for us is a matter of weeks away, which is really exciting, right? So our assets are predominantly in the Perth Basin. We have a little bit in Mongolia, but Perth Basin obviously has an acute gas shortage and we're seeing prices, they've tripled in the last sort of 3 years, right? So it's an excellent place for us to be and have our assets located there. And then you throw on top, a lot of M&A activity that's occurred in the last sort of 6 months. I think a combination of all that makes Talon a really attractive investment, and that's why it should be in your portfolio. So we have a pretty clear vision and corporate strategy. As I said, Talon is an emerging producer, and with financial discipline and high exploration targets, there's an opportunity to create a lot of value. So it's essentially a 3-pillar strategy in that we have high margin production, and that's from onshore conventional gas. And we'll utilize those cash flows to self-fund our organic growth and sort of deploy those cash flows across the portfolio. And then, with success, obviously create some shareholder returns. So we have quite a strong board and exceptional management team. We've recently appointed Greg Columbus as our non-executive chairman. For those of you that know the name Greg Columbus, he was associated to Wargo Energy, and Wargo and their board have a pretty good track record of creating value for shareholders when they were ultimately acquired by Hancock. I myself have worked in the Perth Basin for about 10 years. Previously to this, I worked at Strike. We have a lot of Perth Basin specific experience within our management team. And in terms of sort of skin in the game, I mean, I'm a significant shareholder for us. And I've put a ton of my money in the own stock, in our stock. I'm our 26th largest shareholder. Greg Columbus, our chairman, is inside our top 40, and we own about sort of 4% of the company altogether. So if we look at what the portfolio looks like, we start maybe if you see the pictures at the bottom in the Perth Basin, so our 45% interest in Walyering. Again, that's the asset that's coming into production. In the North Perth Basin, we have 25% interest in L7 EP437. And then Condor we'll have 100% of that in the sort of South Perth Basin. And then obviously a little bit of exposure in Mongolia in the South Colby Basin in Grovantes, and that's a coal seam gas project, somewhat similar to what Tor was just talking about. But yeah, what does that give us? Gives us high margin, near-term production, material exploration upside, geologic and market diversity, proximity to infrastructure, and then exposure to tightening gas markets in both Western Australia and China. So for a smaller cap company, we do have quite an enviable suite of reserves and resources. Just about 1,000 PJs 2U prospective, 500 PJs 2C contingent, and then 24 PJs 2P reserve. So obviously we want to utilize our cash flows to sort of move from prospective into contingent into reserves, and then sell those reserves on the market. So if we dive into the portfolio a little bit, we'll talk to Perth Basin, and it really is a world-class gas province. Our exposure there, sort of from top to bottom, if you can see the graphic there, EP437 is at the top. That's a King A gas target that we're drilling next year. You can see all that sort of activity, all the little red dots there. I mean, those are sort of prolific gas discoveries, and our 25% interest in this permit really sort of puts us in a VIP postcode. Walyering, as mentioned, is our sort of cornerstone asset that's coming into production. We're 45%, and Strike Energy are 55% and operator. And Stu will talk a little bit about the project after I'm done. But yeah, we've taken FID, and first gas is imminent, and it's a tremendous milestone for our company. But importantly, what it means is that we'll generate $30 million of operating free cash flow per annum, right? And we'll utilize that to fund our growth. So last but not least, in the Perth Basin, Condor is an exciting prospective resource with 400 BCF perspective, and a very sort of rich liquids profile with 20 million barrels of oil behind that. And you'll notice our entire portfolio really is right on the pipeline, right? So it's reasonably easy to commercialize all these resources. So if we talk a little bit about sort of what's happening in the Perth Basin, this consolidation activity, I guess I sort of made mention of it before, but here's a zoomed in version of these sort of prolific gas discoveries. And one of our assets is in turquoise there, L7 and EP437, right? So yeah, basically what you're seeing is all the M&A interest is driven by miners trying to secure supply, or existing oil and gas companies trying to shore up their infrastructure position. Try to create a little graphic to show where everyone is there, but yeah, you'll see Strike and Hancock, Minres, Beach Mitsui. So this permit in particular, which I'll talk to in more detail, is immediately west of Lockyer Deep and immediately north of Waitsia. Yeah, Minres just announced a discovery called North Arugula Deep, which is just 10 kilometers from L7 that you see there. And of course, the pipeline runs right through it, right? So Talon at $120 million market cap, is let's call it sort of a bite size. We're the second largest remaining independent company. There's has to be a wave of consolidation that's sort of come through the Perth Basin, similar to Queensland, in the last sort of 5 years. So I think it's something to keep in mind. So if we looked at two specific examples over Christmas in the early part of 2023, we saw Norwest Energy, who was the target of mineral resources. Both Norwest and Warrego were non-operated partners, and their operated partners, commenced M&A activity, right? And I guess, like those two companies, we're non-operated as well with a similar market cap, right? So Yeah, there's a 65% premium for Norwest as they were acquired, and Morgo got 165% premium out of Hancock in a cash bid at the end. So, you know, Perth Basin, very, very exciting place to be. So if we talk to WA gas economics, I think simply, you know, domestic gas in Western Australia just wasn't sexy 3 years ago, right? I mean, when you're selling gas for $3, you know, it didn't sort of command any real interest, but with a gas price of around sort of $10 spot price, you know, we've seen the gas price obviously triple, and I think it's made domestic gas quite sexy. And really that's sort of driven by, you know, classic sort of supply and demand, right? Supply has really sort of tapered off with major offshore projects writing down some of their resources and reserves, and then sort of demand really picking up in terms of, you know, mining and mineral processing and ultimately power generation, right? So that's what's sort of, you know, driving this increase in price. And, you know, I think the forecasted demand is so large that arguably prices, you know, will stay north of $10 and probably touch somewhere around 15 in my personal opinion. So if we dive into assets a little bit more, Wallering has mentioned, you know, our 45% interest is definitely our cornerstone investment, right? So first gas is imminent. I was just up on site last week. We announced yesterday that, you know, mechanical completion is 2 weeks away. But if we talk to the facility itself, it can produce up to 33 terajoules a day and around sort of 250 barrels of condensate processing. It's 100% solar powered, which obviously reduces carbon intensity. It's super cheap, frankly, right? I mean, you know, we're lucky that this discovery was 440 meters, you know, from the pipeline, and that's enabled us to build sort of for around $25 million gross, right? So importantly for us, there's two revenue streams, right? So you have gas and you have condensate. We sold our gas to Santos. They've taken 36.5 out of our 54 petajoule 2P reserve. And that leaves 29% uncontracted. Again, in sort of $10 spot prices, should we get exposure to that? And yeah, condensate actually is probably about 15% of the revenue. So it's still pretty significant for us. So there's just a couple sort of more detailed pictures. As I mentioned, we're sort of 2 weeks away from mechanical completion. What'll happen then is, you know, basically you get the facility RFSU ready for startup. And then once the government sort of gives you permission, you'll introduce hydrocarbons into the facility. They begin the commissioning process, and then ultimately, you know, start selling gas to Santos, right? So, yeah, it's, you know, and really it's only a couple hours from Perth as well, right? So very accessible. But yeah, it's one of the fastest gas monetization cycle times in the Perth Basin, right? We had exploration success, and we're coming to produce gas in roughly 18 months, so it's pretty impressive. I'll talk to Wallering just quickly. You know, yes, there's been a lot of focus on getting the facility into production, right? But there's still a ton of upside within the permits. What you can see there on the right here is a Wallering facility, right? That's 10 square kilometers. There's some very sizable sort of leads up here, you know, that are, you know, 16 times, 10 times, and 4 times the size of that. We have to do a bit of work to move those into, you know, something that's ready to develop, but still a ton of upside. Okay, so we've talked to North Perth Basin and L7. You know, really this is, I guess, a more detailed view of, oh, sorry, let's go back one. There we are. This is a more detailed view of what those what the prospects are, right? So, you know, we farmed into L7 at 25% interest in March this year. We really like it because it has 3D, and 3D has enabled our success so far. So we've interpreted that 3D. We've high graded three separate prospects that combined have 400 BCF of gas. And I keep on saying, you know, 400 BCF is sort of coincidental, right? But 400 BCF is $4 billion worth of gas sales in terms of revenue on a $10 gas price, right? So, you know, the size of the prize is huge in this sort of market. Okay, and last but not least, Condor, again, is 400 BCF coincidentally. And again, a significant liquids profile in 20 million standard barrels. What you see there is both the WA's pipelines, the Parmelia gas pipeline and the BBNGP. They're 5 kilometers from the prospect. And this is a really exciting prospect for us to drill in 2025. So if we change tack, and I guess I'm lucky to follow Tor and talking about coal seam gas, the Gravantes project in the South Colby region of Mongolia is a very exciting CSG project, right? So it's right on China's doorstep. You can see here that, it's 20 kilometers from the Chinese border. This is China's west-east gas pipeline. People sort of throw around the term world-class, maybe I'll say world scale, but 1.2 TCF is a huge resource, right? So we farmed into that. We have a 33% interest in it. And it's a tremendous project, right? So we've seen excellent success in drilling it. We've drilled 3 pilot wells, and basically we're just getting ready to insert pumps and bring the water out and bring gas service in the next couple of months. So keep an eye out for that. So my second last slide really just sort of talks to what it looks like for us over the next couple of years, right? So cash flow from watering up at the top will enable us to drill sort of 5 wells in watering, L7, EP437, whether that's sequential, that sort of depends on rig slots, but yeah, 5 wells in the next 2 years. And I think we're really sort of deploying that cash flow to add value. And then obviously Gravantes pilot well will sort of produce gas until the end of the year, hopefully. So I think, Talon is definitely a compelling investment opportunity. We're fully funded for development. We have significant near-term cash flows, tangible high impact exploration and growth catalysts, exposure to Perth Basin M&A market that's very hot, and it's the best value opportunity relative to our peers, right? So it's an excellent time to come into the stock as we enter production. We're just getting coverage from several major brokers, and there's just a ton of catalysts in front of us. So thanks very much for your time today.
Very impressive that you just wrapped it down to the last second. Give him another round of applause for that. That was bloody impressive. Well done. Lois, Jackson's going to catch in front of you, former AFL player. There you go. He's going to catch that. Mate, no wonder you played for the Eagles. No wonder we were tough. Can you give that to your brother? Is it your brother or husband? Who's that? That man living next to you. Husband? Good looking rooster. Can you give that to him? He just needs a bit of a wake up. God bless him. All right. I'll give you another reason to wake up too. We've got drinks after our next presenter, courtesy of Wilson's. And I want to go back to what Wilson said at the start of the day. Do you remember they said to us, we want our investment teams to be led by well-credentialed and well-skilled people. So as this fellow here strides up onto the stage, this is Stuart Nicholls. He is the MD and CEO of Strike Energy. He's taking the penultimate spot for day one of the showcase. He has led the transformation of Strike from its exploration roots into one of Australia's first integrated developers of gas and renewable energy. And he is committed to leading Strike to net zero 2030.
Thanks.
You know a few things about leading, don't you?
Absolutely.
What have you got, a Bachelor of what?
Commerce.
Commerce, that is correct. How
business.
many years have you been in this industry for?
I've been CEO for about 6.5 years.
Okay, and what sort of things were you doing before that that might give you an edge over other people to lead, build a team and build morale?
I worked for Shell for about a decade, and then I was an army officer previous to that.
Bingo. All right, so this man knows how to put together a great team and get them to work together. Would you please make him welcome today?
Thank you very much, and really appreciate being the last person on the stage today, so everyone hanging around and waiting to get to Origin. But just for those that aren't aware of Strike, Strike is a $1.2 billion ASX 300 listed developer of pure play Perth Basin assets. Likely heading into the 200 in September this year. It's been a wonderful success story of Australian energy where there are few and far between winners in that space. If you only walk away out of this conference and buy one stock, it's this stock, it's Strike. And the reason why I tell you that is because we're about to have an amazingly big 6 months in the second half of the year. We're starting our production up. We're about to take a final investment decision on another one of our major 100% owned assets. And we start drilling in a very, very high impact exploration and appraisal program, which I'll take you through in a minute now. But given that you've spent the day watching miners and lithium and gold explorers tell you about their great portfolios, one of the things that bonds all of those people together is their energy consumption. I come from the great state of Western Australia, where we are very good at digging stuff up and pulling it out of the ground. I'm going to walk you through a little bit of information about how Western Australia is participating in the energy transition and how Strike and our gas in the Perth Basin is absolutely central to that story. So what you can see here in two little donuts is a evolution of the electricity sector in Western Australia. In WA, we have a state-owned and operated electricity generator. Now, the political football of our coal mines has been kicked down the road for about 10 years. And unfortunately for WA, the two domestic coal mines have pretty much all run out of coal. That's led the state government to make the decision to exit coal-fired power by 2029, which is really a reality of what they have to do because they've run out of coal. As a result, they're looking to backfill baseload coal-fired electricity with both renewables and gas. And so what we can see as the coal has started to go into distress, you can see on the right-hand side of this chart here, just over the space of 3 small years, the rise in the average balancing price for a megawatt hour in WA. This is happening in a state where the West Australian government owns and operates the electricity generator. So what is actually happening is there's about 5 hours a day on average that we are seeing gas price equivalents of electricity traded around 10 Australian dollars a gigajoule. When I made my first discovery in the Perth Basin in 2019, the gas price was about $2. Most equity investors said to me, you found gas in West Australia, who cares? So in the space of about 4 years, we've seen the gas price go up about 5 to 6 times. What's happening on top of this is we've got a massive rise in demand. As I said, everything that bonds all of us together in the resources industry in WA is our energy consumption. All of these critical minerals, these green minerals, these battery minerals that are the focus of equity investors today. But for every train of lithium hydroxide, I see 8 terajoules a day of gas demand that will sit in the system for an extended period of time. To make lithium hydroxide, you take spodumene, you put it in a kiln, you crack it at 1200 degrees centigrade into spodumene A so you can dissolve it into sulfuric acid. 1200 degrees centigrade is not easy to develop on a 24/7 basis with renewable energy. On top of that, people talk about the copper boom, but actually at the end of the day, power lines and major transmission lines are actually made of aluminium. So that's a 100% fact. They're not made of copper, they're made of aluminium. Australia is the second largest exporter of alumina. West Australia produces 70% of Australia's alumina. We currently, the largest gas consumer in Western Australia is Alcoa. They consume 270 terajoules a day to produce 9 million tonnes of alumina. We have South 32 that's running their alumina refineries off coal still. They're about to move that to gas. The next one is low carbon steel. So when we talk about the movement into net zero and Fortescue and Rio and FMG, all moving into low carbon steel, they're all now targeting major magnetite deposits. Those major magnetite deposits, whilst they will produce steel at the end of the day and the end of the value chain that is about 30% less carbon intensive than steel produced from the traditional hematite, the amount of energy consumed in the mining and the crushing of magnetite versus hematite is 3 times. And so for every 20 million tonnes of processed magnetite ore that we produce in WA, you are generating 50 terajoules a day of new gas demand. And the last one is we're trying to replace about 900 megawatts of coal-fired power in WA with a mixture of renewables and gas. For every 3 megawatts of capacity, you need 1 terajoule a day of new gas supply. And the unfortunate thing, as we will show you, is the gas is in a massive shortage of supply. We've seen an extended period of time of underinvestment over the last 10 years. The top left-hand chart shows you the amount of drilling that's happened in every oil and gas basin that can be connected into the West Australian gas reticulated network. On top of that, we've had domestic gas-only fields water out ahead of schedule. They've had early breakthrough of reservoir fluid, and that means that we're writing off reserves. We've also had consistent exploration failure over the last 10 years, which has been compounded with 2 downturns in oil and gas pricing. That's really completely diverging against the backdrop of rising demand. In fact, we're building new fertilizer plants in Western Australia. We are building new pipelines to connect the Perth Basin to the goldfields, because all the goldfields are burning diesel to generate their power at the moment, whereas they want to use renewables and gas. We've also got the West Australian government, who's going to increase demand by 163 terajoules a day. That's another 17% of WA's domestic gas demand will increase by 2029 to exit that coal-fired power. And then finally is the rise of mineral processing. I think that soon we'll get to a point in Western Australia where you cannot export raw materials anymore. You actually will have to commit to a level of high grading, whether that's taking spodumene to lithium hydroxide or magnetite into hot briquette iron pellets. So what's happening at the moment is we've had all these large industrial gas users squirreling their gas away for the last 10 years in the gas storage facilities. And the bottom right-hand chart shows you consistent withdrawals from gas storage over the last 2.5 years. And so when we look at the chart on the right-hand side of this picture here, that shows you the spot price of gas in Western Australia. That is not a true reflection of what the price should be, because people are pulling on their stored $2 and $3 gas from several years ago. So the gas price is $10+ a gigajoule once that storage runs out, which is forecast to happen in the next 2 years. The chart on the left-hand side shows you the supply and demand of gas in Western Australia. The blue is the supply, the yellow is the demand. You can see the kick up in the demand of gas late in the decade, and that's the exit from coal-fired power. We are moving into our own crisis. We've watched the East Coast go through an energy crisis. The West Australian government very recently only lauded its management of WA's energy system, but now we are finding ourselves in the exact same pains of the energy transition that everyone else is going through. But our energy transition is being supercharged by the fact that we're trying to create the energy transition for the rest of the world through the proliferation of critical battery and transmission minerals. So how are Strike going to play in this? Well, Strike is the biggest owner of reserves and resources in the Perth Basin. We've got one of the largest acreage positions. We are operator in all of our assets. We're about to bring our initial production online down at the Walyering asset, which Colby, who's our Talon, who's our non-operated partner there, and we're about to sanction another 40 terajoules a day of gas at the South Erregulla field, 100% owned by Strike. We're on a path to generating over $250 million a year of free cash to equity. So after that's greater than EBITDA by about the middle part of the decade, once we brought the 4 gas fields online that we've just had support from the West Australian government. The great news is we're incredibly catalyst rich. Not only are we well funded at the moment with over $190 million currently sitting on the balance sheet, but we've got production starting. We're about to take an investment decision on the next project, and we're moving into an absolutely exciting drilling campaign. That drilling campaign will see Strike move from its existing reserves position today to being one of the largest holders of commercial undeveloped reserves in Australia. That path, that staircase to around 1,200 petajoules of 2P reserves that you can see there, will see Strike eclipse Beach as being a holder of undeveloped commercial 2P reserves, which Beach has across all its basins in Australia and New Zealand, and ours will all be sitting in the Perth Basin 100% under Strike's control. We're going to be drilling about 6 wells. Some of those will be in the very high profile South Erregulla field, which you can see in the middle of the map there, underneath a farm that we acquired last year. We have unfettered access to our reserves and resources through the acquisition of land that sits above it. Those wells will go down and they're very low risk for us. Those wells will look to convert around 178 petajoules of 2C resources to 2P reserves. That's the first well, South Erregulla 2. We'll take the rig in late July, look to spud that in August. From there, we will move, and what you can see here is a bit of a cross section. We're drilling these appraisal wells, South Erregulla 2 and 3, in between gas discoveries. These are effectively up-dip infill wells between 2 known points of conventional gas. The 4 gas fields that I spoke about, we've just received what we call lead agency service from the West Australian government, or that's equivalent to major project status for our entire portfolio, but particularly these 4 projects. The Walyering field, which will be online in a matter of weeks. The South Erregulla field, as I said, that we'll look to take an FID in the next quarter, followed by West Erregulla, which was the field that attracted all of the aggressive M&A from the incoming miners who have identified their own energy shortages and now coming down into the upstream in order to acquire. And then lastly, Ocean Hill, a big piece of sleeping value in our portfolio. To give you a little bit of an idea of who Strike is, I'm a bloke in his late 30s running a fossil fuels business. We are absolutely 100% committed to being the modern version of an energy company in Australia today. And that's why our very first project will be producing energy that is 10 times lower in Scope 1 and Scope 2 emissions than the very next available gas in the pipeline. And we're doing that because our first facility will be 100% runoff renewable energy with battery storage. That means that we can provide gas to industrial customers with the lowest carbon profile that they can possibly have. But the good news for us is it produces a boatload of cash as well. We're going to be generating around $40+ million of revenues. The free cash flow yield will be in excess of $35 million from our share of the project, and there's considerable upside throughout the project life. And this is the last project that I'll take you through, which is 100% owned South Erregulla field. We have just recently announced an engagement with Enerflex, a global natural gas solutions business. We'll be rolling out 40 terajoules a day of new gas processing infrastructure every year for about the next 4 years. This project itself, to give you an idea, 40 terajoules a day sold at, let's call it $8, will produce around $125 million per annum. Our lifting cost is around $5 million, so we'll be generating around $125 million of free cash flow. That's the first 40. Then the next 40 comes online. That's 250 million by the end of 2025. So these are big projects, big gas discoveries. We have been the most successful explorer and appraiser for gas over the last 4 years in Australia. And what we are moving into now we've got a market cap and we're well funded. We can develop all of our assets and we're holding the right commodity at the right time in the right jurisdiction. And that's all I have to say. Thanks very much.
That was good. I felt like I'd just done a little mini educational workshop. Anyone else? I bet you're glad you stopped for that one. And just quietly, while there's no other presenters, I think, in the room, Jackson had said to me earlier this morning, he says, you know, this last guy that we've got today, he's the best presenter. You should tell everyone to stay because he's the best presenter. I said, Jackson, that's not particularly kind and that's not very nice to say to me, but all the other presenters aren't here. That was bloody good. Could you put your hands together again? He said to us at the start, you know, if we walk around and we only invest in one, I think he's given us compelling evidence as to why he should be on the shortlist. So that was fun. Grab your bags, grab your bits and pieces, grab your thoughts, come outside, join us. Wilson's is putting on drinks for us. And I will see you back in the room about 8:30 tomorrow morning, traffic willing. See you then, everyone.